2025 isn't just another year. It's a turning point in the global financial landscape. Inflation remains sticky, interest rates are stubbornly high, and geopolitical tensions cast a long shadow across the world's economies. On top of that, the rapid rise of AI and automation is redefining the very foundations of countless industries. For most investors, this environment feels chaotic, unpredictable, even threatening. But for value investors, the ones who understand the art of patience and the power of fundamentals, this isn't a time to retreat. It's a time to lean in. History has shown us that the best opportunities often emerge during periods of uncertainty. When speculative bubbles burst and hype fades away, what remains are solid businesses with real earnings, strong cash flow, and durable competitive advantages, trading at a discount simply because the market has lost its nerve. Yet value investing in 2025 is not the same as it was a decade ago. The rules are changing. Traditional metrics need to be re-examined, and blind loyalty to old-school sectors could be dangerous. Today's successful value investor must be nimble, informed, and forward-looking, ready to distinguish between genuine value and structural decline. In this video, we'll explore how to navigate the complexities of this volatile environment. You'll discover practical strategies to protect your capital, identify undervalued opportunities, and build a resilient portfolio tailored for the realities of 2025. If you're ready to stop reacting to the chaos and start investing with clarity, this is the roadmap you've been waiting for. 1. Market context in 2025. A landscape of uncertainty and opportunity. The investment landscape in 2025 is defined by high volatility, fueled by a mix of global macroeconomic and technological disruptions. Understanding this backdrop is critical for any value investing strategy to succeed. A. Persistently high interest rates. Central banks around the world, especially the U.S. Federal Reserve, have maintained relatively high interest rates to combat long-term inflationary pressures. This has led to tighter credit conditions, reduced corporate borrowing, and declining valuations in many sectors. For value investors, this presents both a challenge and an opportunity. Companies with weak balance sheets are exposed, while financially solid firms become attractive. B. Geopolitical tensions and supply chain fragmentation. Ongoing conflicts, e.g., Eastern Europe, Taiwan Strait, and the shift toward friendshoring or regionalized supply chains continue to impact global trade efficiency. These factors contribute to unpredictability in raw material prices, logistics costs, and overall corporate profitability, especially in manufacturing and industrial sectors. C. The rise of artificial intelligence and technological disruption (AI) is transforming industries rapidly, leading to uncertainty in sectors like customer service, education, logistics, and finance. While growth investors chase AI-related stocks, value investors must carefully assess which traditional industries are resilient or may even benefit from AI integration rather than be replaced by it. D. Sectoral divergence, tech versus traditional value stocks. High-growth tech companies have rebounded quickly post-pandemic, attracting speculative capital and driving up valuations. In contrast, traditional value sectors, such as energy, consumer staples, and manufacturing, remain underpriced despite stable earnings. This divergence provides fertile ground for value investors to identify mispriced opportunities. E. Shifting investor psychology. After several years of boom-bust cycles, investor sentiment has become more cautious. Many are moving away from speculative assets and meme stocks, focusing instead on fundamentals, long-term cash flow, and intrinsic value. Summary. In 2025, the market is volatile, fragmented, and heavily influenced by macroeconomic and technological forces. For value investors, this means heightened risks, but also rare opportunities to acquire strong businesses at discounted prices. Navigating this environment requires a disciplined, analytical, and forward-looking approach. 2. Understanding value. Investing in a volatile market. Value investing is not just a strategy, it's a mindset. In a market clouded by fear, speculation, and volatility, understanding the core principles of value investing becomes more important than ever, especially in 2025, where traditional valuation norms are being tested by technology shifts and macroeconomic instability. A. What is value investing? Value investing is the discipline of buying stocks that are trading below their intrinsic value. This approach relies on fundamental analysis, assessing a company's financial health, earnings potential, competitive positioning, and management quality. The goal is to find undervalued gems, stocks that the market has mispriced due to short-term fear or overreaction. B. Why volatile markets create opportunities. During periods of high volatility, prices often swing wildly based on emotion, not fundamentals. Fear-driven sell-offs can push strong companies into bargain territory, providing rare buying opportunities for disciplined investors. As Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." C. The importance of intrinsic value. In stable times, market price often aligns with a company's true worth. In volatile conditions, that alignment breaks down, creating a gap between price and value. Value investors capitalize on this gap by buying low and holding until the market corrects its pricing error. D. Patience is a competitive advantage. Value investing requires a long-term horizon. It's not about quick wins, but compounding returns over time. While others panic and jump from trend to trend, value investors stay focused on the underlying business. This discipline can lead to outsized returns, especially when the market eventually rewards true value. E. Adapting value principles to 2025 realities. Not all cheap stocks are good investments. Some are value traps, businesses in terminal decline. In 2025, investors must refine their analysis to include factors like technological disruption, sustainability, and adaptability. A modern value investor blends traditional analysis with forward-looking risk assessments. Summary: value investing in 2025 is about staying grounded when others are reactive. It's about recognizing the gap between perception and reality, and having the courage, clarity, and patience to act on it. In a world obsessed with speed, value investing remains a timeless strategy built on discipline and reason. 3. Practical value investing strategies for 2025. In 2025, value investing is no longer just about buying cheap stocks. With rising macroeconomic uncertainty, industry disruptions, and global shifts, successful value investors must apply modernized strategies. Below are the key approaches tailored for today's complex market. A. Focus on intrinsic value and reliable cash flow. Prioritize companies with strong fundamentals, consistent earnings, high return on equity, ROE, and low debt-to-equity ratios. Look for free cash flow generators, not just paper profits. Cash flow is king in times of tight liquidity. Evaluate whether the company's core business is resilient in both recessionary and inflationary environments. Example: companies in consumer staples, utilities, or diversified healthcare often show reliable performance across cycles. B. Target undervalued sectors with long-term potential. Avoid buying value traps, companies that are cheap because they're dying. Instead, seek out temporarily depressed sectors that are likely to recover or evolve. Opportunities might include clean energy, transition from fossil fuels, industrial automation and infrastructure, healthcare innovation, biotech, aging population trends. Tip: compare sector performance to historical averages and use relative valuation tools like PE, PB, and EV/EBITDA. C. Maintain a cash buffer and stay flexible. In a volatile market, holding a portion of your portfolio in cash or short-term bonds provides dry powder to seize sudden opportunities. This allows you to buy into dips without panic selling other assets. Key benefit: you gain agility while others are forced to sell at a loss. D. Combine defensive and opportunistic plays. Build a core portfolio of defensive, dividend-paying stocks to provide income and stability. Add a satellite allocation for cyclical or turnaround plays with upside potential. This barbell strategy helps balance risk while preserving room for growth. E. Stay emotionally disciplined and data-driven. Don't chase market trends or jump in and out based on headlines. Stick to your investment thesis, grounded in numbers and business fundamentals. Keep a watch list and regularly reevaluate positions when prices swing. Use tools like DCF, discounted cash flow, models, SWOT analyses, strengths, weaknesses, opportunities, threats, sector-specific KPIs to assess performance drivers. Summary: the value investor of 2025 must be both disciplined and adaptive, blending time-tested fundamentals with modern analytical tools. By focusing on high-quality businesses, keeping liquidity on hand, and staying calm amid market noise, you can unlock opportunities others overlook. 4. Practical advice and common pitfalls to avoid. In value investing, especially in a turbulent year like 2025, success doesn't just come from knowing what to do. It also comes from knowing what not to do. Here's some practical advice and key mistakes to avoid. Do this. 1. Do your homework. Thoroughly analyze balance sheets, cash flow statements, and earnings trends, not just stock charts. Understand why a company is undervalued. Is it due to short-term fear or long-term decline? 2. Diversify within reason. Spread your capital across sectors and industries to minimize risk, but don't over-diversify to the point where you dilute your conviction. 3. Be patient and long-term focused. Value takes time to be recognized by the market. Focus on business performance, not just price action. Think in years, not weeks. 4. Use volatility to your advantage. Have a buy zone and add to positions when quality companies dip. Rebalance your portfolio when others are fearful, not when it's trendy. Avoid this. 1. Don't chase every dip. Not all falling stocks are opportunities. Avoid value traps. Businesses in permanent decline. Always ask, does this company still have a future? 2. Don't rely on outdated metrics alone. The world is evolving. Consider ESG factors, technological disruption, and global supply dynamics in your analysis. 3. Don't let emotions dictate strategy. Emotional decisions lead to selling low and buying high. Stick to your process, especially when markets get noisy. Conclusion: value. Investing in 2025 is not for the impatient or uninformed. It's a strategy for those who seek clarity in chaos, who understand that volatility is not the enemy, but an opportunity. By focusing on solid fundamentals, staying flexible, and committing to a long-term vision, you can thrive even when the market feels uncertain. Enjoyed this content? If you found this video helpful, give it a like. Drop your thoughts or questions in the comments. And don't forget to subscribe for more insights on investing, finance, and market strategies. See you in the next one. And remember, in the world of investing, patience is power.